Happy Friday, everyone. Today, I just want to really quickly tell you why should you consider dollar cost averaging, reinvesting, if you will, if you want to call it that, your covered call funds. So, if you are down significantly, the idea is that you would want to compound at a lower rate. If you are going up, if your ETF, let me just put down my coffee. If your ETF is increasing in value, okay, your position hold, and it's increasing because the NAV is going up and your dollar cost averaging at a higher price, look, it's great. That's wonderful if it continues to run up. But what happens if it goes down? You end up trending down at a faster rate as well. So when would you actually want to reinvest your dividends or your return of capital or whatever you want to call them? It actually is at the bottom. Now, you don't want to necessarily chase the bottom. You're waiting for the market sentiment. This is the difference between traders and investors. If you are a trader, you're looking for, directional patterns and MACD and whatnot. But if you're an investor, your time is significantly longer horizon. And so you're not looking for the RSI indicators and all that stuff. As an investor, you're looking at, I don't need to time the market. I need to be in the market. I need to be strategic about the market. Oh, I know that the Fed, if you guys listened the other day, is going to start quantitative easing in the sense that they're going to start issuing, it's like $40 billion monthly for the next couple months. They're going to start injecting capital into the allocation. That's bullish. Okay. So you're like, okay, we're going down. That's a good idea that market sentiment is going to start changing to go up. So I'm going to start reallocating. I'm going to buy the dip because especially in a covered call fund, that's where your value is. That's where your total alpha is reinvesting when your position size goes down, because you're going to get capped out as it starts chopping back up. You're going to miss out on those gains. Where you don't miss out on a covered call fund is the fact that our covered call ETF, mind you, is you have a 1-to-1 exposure to the downside minus your premium. Okay, you always got to put minus your premium. So it's a 1-to-1 exposure to the downside. That's your alpha. Okay, is that exposure, so then you can reinvest. You can dollar cost average down. So when you do start chopping back up, again, it's covered call. So you're gonna miss out. And I'm doing some painting on some molding. You're gonna miss out as it chops up. The percentage in which it goes up, you're only going to be able to buy fractional amount of shares as it goes up. So as the price returns back up, your alpha starts shrinking on the covered call fund because you're getting capped out. Your total portfolio is still going up, but how much you can buy is subjectively decreasing. While on the other side, if it goes down, if you're dollar cost averaging in or reinvesting your dividends, the further it drops, the greater the distance, the more shares that you can buy. Now, this only works if the fund as a whole is a solid fund. If you're just chasing high yield garbage, stuff like that, that's a falling knife. That's just you'll never catch the bottom of that. It's mathematically impossible. Okay. If a fund's going down like this and you're just reinvesting, just get out. But if it actually has an underlier, something that you believe in, something that is poised to return back up and swing back up, you don't make money when things return back up. You make money as things condense, consolidate, and then change direction back up. That's where the real alpha is made. So it's something to think about. Especially because I do a lot of options trading, and I'll tell you the position I took this morning because I have yet to post this on social media. So this would be the first time you guys hear this. I have white paint on my nose too. That's funny. Now you guys just come to deal with it. I've been trading open for the past it's been 2 months. I started the position 35 contracts at $8. I cash secured put, always get paid to take the trade. There's no exception to that rule. Instantly, as soon as I got it signed, I covered called it. Okay. Yesterday, and that dropped my cost basis down to, I don't know, like $4. Let's say about $4. Yesterday it fell. Okay. So I was able to close out my covered call for a substantial profit. Okay. Because again, when you have a covered call, as the price falls, right, now you're in profit. You're actually out of profit if the covered call goes up past your strike price, you're no longer in profit. So if you are an options trader, your alpha is actually when it falls, so you can re-enter at a lower cost basis and you can capture that premium. Okay, so that's what I did. So I gave back. I had earned when I did the covered call position. I earned, it was like $4,700 when I did that. And all in the back of my mind, I'm trying to get to a negative cost basis. So I took on $4,700. Yesterday I gave back, it was like $1,900. I bought to close. It was a February strike. It fell in the money. I'm like, I'm taking, I'm taking some profit. Okay. I profited handsomely off that trade yesterday, even though I gave money back because the price fell. Then this morning, and that was at, I don't know, I think it went down to like 670, and took some profit, closed this morning. It went back up past over $7, like, I don't know, 721, something like that. I opened up a new position, a new long position, 35 contracts. This time I did it for $12. Okay. And I made, it was like another 300, and it was like $350 in premium. I forget what the actual premium amount was though. It was a little over $11,000 I collected in covered call money this morning, which brings my total adjusted cost basis down to like $2.10 for my open position. I'm almost at negative. If we get another big swing again, I'll be able to close it. So now that's what I'm looking to do. I'm looking to close my open position, my open covered call position again, because if it falls, I'll be, super profitable. I'll just be able to keep the premium with uncapped upside potential, right? Because I'm unleveraging it. So if it falls, I'll close that position. Right now the strike is 12. And I think the stock this morning was trading at, when I opened it, was like 717 or 720, something like that. Okay. So I have a lot of intrinsic value there, significant. But if it doesn't, okay, now again, my cost basis is about 2. If it doesn't, some reason it rips up, it goes up to 14, 15, 16, whatever. Again, my cost basis is 2. From 2 to 12 ends up being, it's like 2 and some change. Ends up being like a 560% return on my money. I'm really trying to get to a negative cost basis. Now, if I factor back in, I got a bunch of warrants a couple weeks back. They issued warrants. I have 3 sets of warrants. If I factor back in the value out of those, I'm probably at closer to like and I haven't done anything with them. I haven't done covered calls. They're just sitting in my account, 100% profit, because again, I don't have any of my own money into it, 100% profit. I'll take all the warrants you guys want to give me, okay? Forever. I'll just hold them forever. And I'm trying to get to a negative cost basis, but I think if I was to factor back in the free warrant money, I'm probably closer to like $1.50 as, more of a true cost basis, because I wouldn't have gotten the warrants had I not held the underlier from the initial position. I didn't know that they were going to do that, but they did. So that's it. So that's my story. And I hope you guys have a wonderful Friday. I think I'm gonna head down to Newport, Rhode Island. I'll stop in and see James Patrick Keel. See if he's at the store. If you guys are from Newport, you'll know exactly what I'm talking about. It's the most they do the most exceptional decorations, especially around the holidays, really year round. They get the hydrangeas and stuff up front in the summertime, and the massive pumpkin display in Halloween, and right, they're all set up for Christmas. It's beautiful. It's New England to a T. And yeah, that's pretty much how I started my Friday. If it took me about, I don't know, 10 minutes with the trades this morning, I have other trades going. I'm not going to talk about them today. This just was supposed to be a quick video, just a recap to see how you guys are doing. And clearly, I have to shave. But my kids had, a concert last night at their school, so I didn't get home till late. And I've been working, doing lots of marketing, lots of videos. I think you guys saw my video the other day with Patrick Neville and Brett King. Fantastic, super early video because we thought that Brett was in. I think he was supposed to be in Singapore, but he ended up in Brazil, and it worked out. Whatever. Kind of cool. He was using for internet service. He was using the Tesla internet, the whatever it's called, the Starlink internet in Brazil because they didn't have internet service there. So he brought the Starlink with him. It worked exceptionally well, by the way. So I would definitely suggest getting one of those if you guys don't have one. And yeah, that's about it. Like I said, I'm gonna head down to Newport, grab some wine for the holidays, and probably have a whiskey tonight. I'm thinking Midwinter Night's Dram. A couple of my clients, exceptional people, they gave me some, nice holiday checks. I'll tell you, and I can get a couple bottles for not really for the holidays or for anyone else, but really just for me, just because I like it, and I believe the ribeyes are on sale tonight, so I think I'm gonna do Midwinter Night's Dram and a ribeye. Tell a good story, sit by the fire, and enjoy a nice New England crispy night. It's like 20 degrees, and that's it. But we'll see you guys later.